Columbia University, 2009. Warren Buffett looks out at a lecture hall and makes an offer. $100,000 cash, right now, for 10% of any student's future earnings. Not their company, not their idea, them. Most people in that room completely missed what he was actually telling them about their own net worth. He was not being generous. He was being precise. Buffett does not make imprecise offers with his own capital. If he would pay $100,000 for a 10th share, the implied valuation of the whole asset is exactly $1 million. You, as a going concern, as a cash flow generating machine, $1 million balance sheet entry that never appears on any personal financial statement. Before we go further, if you are here to build a serious, long-term framework for financial thinking, consider making this channel part of your permanent curriculum. A subscription is a small act of personal accountability. And when you are finished watching, share your core investment philosophy in the comments.
This is a global classroom, and your perspective sharpens the thinking of everyone in it. Now, back to Buffett's math. The baseline is $1 million. That is what a young, educated professional is worth the moment they step into the labor market. Not their stock portfolio, not their savings account, not their car. Their future capacity to produce output of measurable economic value. That is the asset. And almost no one manages it with the seriousness it deserves. Every financial strategy you have ever been sold, the index fund allocations, the real estate plays, the Treasury inflation-protected securities, all of them are attempts to protect wealth you have already accumulated. But the single largest asset on your personal balance sheet is the one you have not yet converted into capital. It is still inside you, undeployed, unoptimized, and quietly being eroded. The erosion agent is inflation.
And to understand why human capital is its antidote, you first have to understand exactly how inflation kills everything else. Buffett has used one word for it consistently across decades: tapeworm. Inflation is a tapeworm living inside your portfolio, consuming your purchasing power from the inside, while your nominal account balance stays perfectly still. Here is how the tapeworm operates at the corporate level, because the mechanics are identical for your personal wealth. A capital-intensive business, a steel mill, a railroad, a manufacturer, must reinvest enormous sums simply to maintain its existing capacity. When inflation rises, every input cost rises with it. But here is the trap. The tax deduction a company claims on its aging equipment is calculated at what that equipment originally cost. The bill to replace that equipment arrives at today's inflated price. The gap between those two numbers is pure wealth destruction.
The same trap closes on the individual investor who parks capital in long-duration fixed-income bonds. You lock in a coupon rate of, say, 3%. Inflation runs at 5%. Your nominal account balance is unchanged. Your real purchasing power declines by 2% every single year. The number looks fine. The wealth is gone. Nominal gains flatter. Real returns, returns generated after inflation is subtracted, are the only metric that builds true wealth. And the savings account is the most insidious version of this trap. The yield sits demonstrably below the consumer price index, yet it feels safe. The balance never drops. The tapeworm, however, is completely indifferent to how safe it feels. It is consuming your capital at the rate of the inflation differential every single day while you sleep.
A business that owns a dominant brand can raise prices in direct proportion to inflation because consumers will continue to exchange a fixed quantum of their daily labor to acquire the product. The real value of the transaction remains constant even as the nominal price climbs. Pricing power is the antidote to currency dilution. Which brings us directly back to you, because a highly skilled professional is, structurally,
a pricing power asset. If your specialized expertise makes you genuinely irreplaceable in your field, you command a proportional share of national economic output. And that share holds regardless of what the currency is doing. When the dollar weakens, the price of your labor simply adjusts upward to reflect its persistent real market value. Your skills do not have a fixed coupon rate. They are not denominated in any currency that a central bank can debase.
Researchers studying how people's earning capacity evolves across a lifetime and how retirement products are built around that curve have tested this claim rigorously. The conclusion is consistent. An individual's future labor income naturally outpaces inflation. That holds across virtually all interest rate environments. It holds regardless of starting income level. For younger demographics especially, human capital represents the overwhelming majority of total wealth, and it is the one component of that wealth that moves with inflation, not against it. Think about the arithmetic of your own balance sheet. Early in a career, the present value of your future earnings dwarfs the value of your financial assets. The stock account, the retirement fund, these are real, but they are small. The enormous, dominant position is the decades of earning power ahead of you.
Portfolio theory, applied honestly to a 30-year-old's full balance sheet, would classify this as the primary asset requiring active management. Instead, most people spend hours optimizing a $20,000 brokerage account, while spending 0 hours optimizing the $1 million asset that generates the capital for that account in the first place. Here is where the valuation framework gets precise. Human capital can be modeled exactly like any cash flow generating business. You discount future earnings at an appropriate rate, sum those present values, and you arrive at the intrinsic worth of the asset. In this model, any enhancement to your earning capacity functions as a direct increase in the asset's intrinsic value. The math is identical to a company expanding its profit margins. When the margin goes up, the valuation goes up. Ask yourself this: when did you last conduct a formal internal audit of your most valuable asset? Not your brokerage account, not your home equity.
The asset Buffett would pay $1 million to own a piece of. When did you last ask, with genuine rigor, what is this worth? What is limiting its output? And what is the highest return investment I can make in it right now? The numbers that answer that question are unambiguous. A comprehensive analysis of 1,120 separate estimates across 139 countries finds that the private average global rate of return on one additional year of focused education and skill acquisition is approximately 9% annually. That figure is drawn from decades of empirical data. 9%, consistently, across geographies, across economic cycles, across income brackets. At secondary and higher education levels, the social returns to that same investment exceed 10% annually. These are not projected returns. They are measured, historical returns on the asset class.
And the single most leveraged version of that investment, the one that Buffett identified by name at Columbia, is this. Any skill that increases your aggregate output and marketability by 50% instantly generates $500,000 in unrealized capital value on a $1 million baseline. $500,000, created internally, no external capital required. Now, consider the alternative asset classes competing for that same investment capital. A savings account operating below the CPI, a bond with a fixed coupon that inflation will quietly consume, a speculative position in a company whose pricing power you cannot verify. Against a 9% historical annual return on human capital development, these are not close comparisons. The highest yielding investment in the global economy is the one most people treat as a soft, optional afterthought. There is a word for an asset that is intrinsic, portable, and inflation adjusted by definition. That word is knowledge.
A government can impose a windfall tax on your real estate gains. A currency crisis can vaporize the purchasing power stored in your bank account. And physical property, under sufficiently hostile conditions, can simply be taken. None of those mechanisms has any reach over what you know and what you can do. This is not a theoretical edge case. It is the structural property of the asset class. And when you frame it in those terms, not as self-improvement, not as career advice, but as the rational management of your single most valuable balance sheet position, the investment mandate becomes obvious. You are $1 million asset. The question is not whether to invest in that asset. The question is whether you are leaving $500,000 of unrealized capital value permanently on the table. Most people are. And the mechanism by which that value goes unclaimed is not laziness. It is not lack of access.
The information required to compound this asset exists at near zero marginal cost. The mechanism is something subtler and more systematic, a structural hijacking of the very attention required to do the work. But hold this number before you go further. 9%. Annual, historically measured on your primary asset. That is the baseline return available to anyone willing to manage what they already own with the seriousness it deserves. Inflation can tax your savings account. It has no mechanism for taxing your judgment. Every great business Buffett has ever owned shares one defining characteristic. It earns well today, and it can defend those earnings tomorrow. He calls that defense the economic moat. Your career is a business. Your skills are its products. And like any business operating without a moat, competition will eventually grind every advantage you have down to zero. So how do you build one?
Most people assume the answer is total mastery, becoming the absolute best in the world at a single discipline. But the top 0.1% in any field is a nearly unreachable target. There is a more reliable path. Reach the top 10% in 2 or 3 complementary fields simultaneously. A software engineer who also writes with precision and leads teams with clarity is not competing in a crowded market. She has created a new market of one. This is skill stacking. It compounds. Each additional layer of competence does not simply add to your value, it multiplies it. And it makes you structurally harder to replace. But of all the skills you can stack, one generates a disproportionate return. Buffett has named it specifically. He has said, publicly and more than once, that improving your communication skills will increase your professional worth by 50%. 50%.
On a $1 million asset, that is $500,000 of unrealized value, sitting dormant, waiting to be unlocked by nothing more than the ability to articulate an idea with clarity and force. The market confirms his math. Nearly half of all surveyed businesses actively pay for employee writing training programs. They are not doing this out of generosity. Clear communication is a direct multiplier of organizational output, and they have measured it. Before we go further, this content is for educational purposes only. It is not personalized financial or career advice. Every individual's circumstances differ, and nothing here should substitute for professional guidance tailored to your specific situation. The infrastructure for building your moat exists. The knowledge is accessible. The return is documented. The path is mapped. So why are most people not walking it? If the opportunity is this clear, why are most people not taking it?
Here is the answer, and it is uncomfortable. The average American now spends 6 hours and 12 minutes every single day looking at a screen. Not working, not learning, scrolling. Among adults aged 18 to 29, the demographic with the most human capital left to compound, 23% spend between 9 and 12 hours daily on screens. 8% exceed 13 hours. That is more waking hours than most people spend at their jobs. And 69% of people in that same age group say they want to reduce their screen time. They already know. They simply have not yet chosen to act on what they know. Meanwhile, deliberate reading, the single practice most directly linked to the communication skills Buffett prizes, is collapsing. Less than 20% of American teenagers read a book, magazine, or newspaper daily for pleasure. Over 80% use social media every single day. This is not a generational preference.
It is a measurable cognitive shift. Excessive screen time changes how the brain's attention systems are wired. The circuits that govern focus and self-control become less efficient. The very machinery required for deep, concentrated learning begins to degrade. Think of it like a muscle that is never trained. It does not stay the same. It atrophies. Adolescents with high and rising social media use show documented declines in reading comprehension and memory scores compared to peers with minimal digital engagement. The gap is not theoretical. It shows up on tests. There is also a subtler problem. Reading a long article by scrolling on your phone is not the same cognitive act as reading a physical book. Researchers call this the screen inferiority effect. Think of it as the difference between walking through a building and looking at a photograph of it. You can absorb the image, but you never learn where the stairs are.
Deep comprehension requires the real experience, and casual digital reading rarely provides it. This creates a paradox that would have seemed impossible to any prior generation. Every library ever assembled fits in your pocket. Access to the world's accumulated knowledge costs nearly nothing. Yet structural attention deficits are preventing the deep work required to actually internalize any of it. That paradox is your opening. Every hour your peers spend in algorithmic distraction is compound learning they are not doing. Every week of cognitive drift they accumulate is a widening gap between their moat and yours. Competitive advantage does not always require you to accelerate. Sometimes it only requires you to not stop. Reclaim just 10% of the time currently lost to scrolling. For the average person, that is 30 to 45 minutes a day. Redirect it toward rigorous, deliberate learning.
This is the trade of the decade, giving up distraction in exchange for compounding capability. No broker required, no capital at risk. The framework is built. The threat is named. The trade is sitting on the table. But every theory has a breaking point, the moment reality stops cooperating. There is one final question this framework must answer. What happens to human capital when missiles are falling? Forget a recession. Forget a bear market. Forget inflation running at 8%. Ask yourself this. What happens to every traditional asset class when missiles are actually falling? Ukraine answered that question in real time, and the answer should permanently change how you think about wealth. When the war began, Ukrainian real estate became functionally illiquid overnight. You cannot sell a property under missile fire. You cannot find a buyer when the buyer has fled. Sovereign bonds did not fare better. Ukrainian war bonds were trading at approximately 36 cents on the dollar. Every dollar stored in that instrument lost 64 cents, not gradually, not through inflation, but in a single geopolitical event. The currency collapsed. Savings accounts watched their real value evaporate. Every traditional store of wealth, property, bonds, domestic currency, failed simultaneously. This is the scenario financial planning textbooks rarely model. Not one crisis, all of them, at once. But here is what did not collapse. The Ukrainian IT sector generated $7.85 billion in revenue in 2025. In the middle of an active war, that sector became the nation's second largest export industry. It accounted for 40% of all service exports. It contributed between 3.5 and 4.5% of the entire national GDP. It sustained 800,000 jobs and delivered over $1.2 billion in tax revenue to a government fighting for its survival. Why? Because intellectual capital travels through the internet. Code does not require a shipping route. A software contract does not need a port that is open. Knowledge work crosses every front line without a visa. When the World Bank studied education interventions inside Ukraine during the conflict, online tutoring programs returned between $31 and $56 in future economic value for every single dollar invested. That is equivalent to 2 to 2.5 years of standard academic learning gains, documented, measured, stress-tested under conditions no asset manager would ever voluntarily model. That is not a return on a stock. That is not a yield on a bond. That is the return on a human mind. Now, bring this back to you. Your conditions are more favorable than anything Ukraine's workers faced.
The only question is whether you are treating your own development with the same seriousness that their circumstances demanded. The average person spends over 6 hours on screens each day. 10% of that is 30 to 45 minutes. You do not need to rebuild your entire life. You need to redirect 30 minutes, daily, deliberately, toward a skill that compounds. That single reallocation is where the gap between your current trajectory and your potential one actually begins to close. The organizational data makes this concrete. Companies that build structured training programs report 218% higher income per employee and 24% higher profit margins than those that do not. That gap does not come from hiring different people. It comes from investing in the people already there. The market rewards developed human capital at a premium it cannot stop paying.
Which raises the question of which skills are worth developing most urgently. The skills automation consistently fails to replicate are judgment under ambiguity, ethical reasoning, complex communication, and the ability to lead other humans through uncertainty. These are not soft skills in the dismissive sense. They are the hardest skills to acquire. They are also, in every labor market ever studied, among the highest compensated. Now consider the formal credential question honestly. A top MBA carries roughly $203,000 in direct tuition and program costs. That is before you account for what you give up while attending. Add the opportunity cost, approximately $140,000 in foregone earnings, and the total investment approaches $300,000. The net present value premium that credential generates is approximately $410,000, implying a roughly 20% return on investment. That is a strong return. But the credential is not the only path to the underlying skill. Application is, and application can begin today. The market already prices this logic every day. Replacing a single employee costs an organization 3 to 4 times that employee's annual salary. The moment a company loses a developed human capital asset, it pays an enormous sum trying to reconstruct something that took years to build. You are on one side of that equation. Choose which side deliberately. Every asset class carries an external vulnerability. Real estate has geography. Bonds have governments. Cash has central banks. Equities have sentiment. Human capital has only one vulnerability: neglect. And neglect is the one risk you control entirely. Inflation can tax your savings. War can level your property.
Algorithms can replace your job title. None of them can confiscate what you know. This content is for educational purposes only and does not constitute financial advice. Your specific situation requires your own judgment and, where appropriate, a qualified professional.